G20 wraps up its two-day meeting this afternoon, and while it appears that members are agreed on the issues that are creating trade and currency imbalances, they're unlikely to reach consensus on solutions. Joining us to chat about this as well as currency movements over the past week, Brigid Taylor, currency strategist at Rand Merchant Bank. Brigid, thanks very much for coming in today. And G20, of course, has been on the spotlight for the past week or so. What would you expect to come out of that? Do you think there is going to be any consensus?
I don't think there's going to be any consensus. I think that the market's been, severely focused on it purely because there's been this huge contagion between the US and China, just with regards to global imbalances, looking at currency swings, and obviously post that QE2, which did come out at market expectations, nonetheless, it is ultimately manipulating the currency, which is the very thing that the market is concerned about. Certainly, in our zone, we look at that quite significantly with the impacts that it has on our growth, etc. So I think that this is a debacle that will continue. I don't think we're going to see any clear lines in the sand post G20, and I think that we need to really understand that we are actually in the throes of a trade and currency war that we're not necessarily talking enough about.
It was a very different message that was put forward by the G20 during the crisis, because it was all about coordinated moves to try and get us out of the crisis, so it's changed quite extensively. Some would argue that the US is embarking on manipulating their currency just by the notion of quantitative easing, despite the fact that the dollar isn't stuck within a specific trading range. What are your thoughts on that? And do you think that the people that are making this noise are actually right to say these things?
Yeah, I think that what we're faced with is a couple of issues. The first is that when we initially faced the whole downturn of the economic market by virtue of what happened in the financial sector, it had to be a concerted effort because we'd never been faced with this before. What has happened consequent to that is that the powers that be, and certainly the type of value of trade, is now changing. And whereas in the past it was coming out of the Eurozone, the US, etc., that whole power coming out of China has changed. And I think the voting rights within the G20 are going to be something that's going to be negotiated. Certainly talking about how you can make a decision that's not as a global context, when in fact that's what they're trying to achieve. I think that's where the irritation came from, the move by the Fed to inject further money into the system purely to benefit their own economy.
Of course, every country goes into this meeting with their own vested interests at heart, so every country would like their currency to be a little bit weaker, but they can't all be weaker, can they?
Absolutely, that's the problem. I mean, you can't, unfortunately we're all in this scenario, and I mean, as you've seen with the US, they've been pointing fingers at China, China's pointed fingers at the US, the rest of us in the emerging markets are bearing the brunt of it, and now what you've had this week and the price action that we've seen has largely been driven once again, and it feels as though we're going down the rabbit hole again, is this peripheral European issues. And once, I mean, Greece sorted themselves out by going into the ECB. We had this new structure that was developed. They didn't think they would ever have to utilize it, and as it's turned out, Portuguese, Irish and Spanish debt are once again under the spotlight.
So do you think it's about the ECB basically coming in and buying some of these bonds to stabilize the market? Is that the solution?
Well, the thing is, there is a fund that's been established. So there's a whole lot of what initially happened was there was an emergency fund that was created.
It's a €100 billion fund.
Correct. And there's a whole lot of different variables in terms of the countries that participate within that fund. And the biggest contributors are France and Germany. And what they're turning around now is they're saying there needs to be a haircut made on those funds. We're not happy that the taxpayers are ending up bailing out countries that aren't necessarily making a plan to get themselves out of this by putting in stringent parameters. And I think that this is going to be a debate that's certainly going to be more and more contagious. Whether or not they allow one of the sovereigns to completely default it doesn't seem likely at the moment, but the heels in that we're seeing from Merkel certainly indicate that there's unhappiness within that Eurozone, and specifically within the biggest members who are the biggest contributors, and that's where the concern lies.
Well, in the meantime, we've seen that euro weaken to 136 against the dollar. If you think last week it was a 143 just after that QE2 package, the rand also weakening today, so very close to that 7 rand mark. And that follows the manufacturing data yesterday, which caused some to call for that interest rate cut next week. How do you balance that, though, with a rand that's already on a weakening trend here?
I think that what you need to keep in mind is the rand itself hasn't weakened significantly. If you look at what's happening globally, you've got the pig situation once again rearing its head. You've got the US data coming out relatively positively. So that's coming out as dollar strength across the board. And then on top of that, you've got talks out of China that they're potentially going to tighten rates again. So there's these negative players which are forming quite strong headwinds in terms of the rand at these current levels. But nonetheless, rands remain below that 7 or there and thereabouts. What we're still seeing in the bigger scheme of things is the fact that QE2 is significant. There will be a continued search for yield. And if you talk about unbundling risky assets, what are we viewing as risky assets? I mean, the world has certainly changed quite significantly. If you look at how bond spreads trade in South Africa versus what we're seeing in the European peripheral, we certainly are less risky in my mind than a lot of what was previously deemed as quite a low risk asset, whereas those kind of things are starting to change, and I think those inflows will continue in the medium term in the rand. So I think that our overall view is that rand will remain strong. It helps our inflation outlook. It keeps inflation relatively low. Yes, there's a growth scenario, but I think that this is a global impact.
Well, Brigid, what is the biggest challenge right now facing, investors and facing the global economy? We've got QE2, we've got G20, we've got Obama coming out and saying that there's going to be tax cuts. So there's so many things that are playing out, and we're stuck in the middle of all of this.
Correct. I think that the biggest thing that's worrying investors is the return on their asset. You're not seeing global growth, specifically in the regions that we've been historically able to see those, and especially when you're looking at a rating. If you're looking at an offshore investor, he's very mandated around the type of rating that he can invest in. And unfortunately, that kind of narrows his scope in terms of the fact that interest rates are relatively low, growth is relatively benign. So there is no opportunity for growth within those portfolios. They have to look to diversify, they have to get their head around the fact that ratings aren't necessarily the way forward. Maybe we need to be looking at credit default spreads in terms of valuating actual risk and looking at that in a different scenario and being a little bit more dynamic about how you manage your portfolio.